A lot of traders look at volume and simply say, volume is rising, so a big move is coming. But the real question is, who is creating that volume? Are buyers aggressively pushing the market up, or are sellers dumping into the move? Regular volume tells you the market is active. Net volume helps you understand which side is applying more pressure. In today's lesson, we'll talk about net volume. It is not a complicated indicator, but it can help you see whether a price move is supported by real buying pressure or whether it is just a temporary illusion. Follow me, and we will keep watching the market together, not chasing emotion, but breaking down the logic. Don't forget to like, share, and bookmark. What is net volume? Let's start with the basic idea. Net volume is designed to answer one simple question. Within a specific period, after comparing buying pressure and selling pressure, which side is stronger? In simple terms, net volume equals up volume or aggressive buy volume, down volume or aggressive sell volume. Different platforms may calculate it slightly differently. Some use uptick volume minus downtick volume. Others, especially in crypto markets, may use take or buy volume minus take or sell volume. But the core logic is the same. If net volume is positive, buyers are stronger during that period. If net volume is negative, sellers are stronger. If it is close to zero, neither side has a clear advantage. The difference between average volume and net volume, this is the key difference. Regular volume tells you how much trading happened. Net volume tries to show which side was more aggressive. For example, imagine a candle with very high volume. A beginner may say, volume is high, so the trend must be strong. But the better question is, was that volume driven by buyers or sellers? If price is rising, but net volume is negative, that is important. It means price is moving up, but selling pressure is still present. The market may be getting pushed up temporarily while sellers are still active above. On the other hand, if price is falling but net volume is not strongly negative or even starts to recover, it may suggest that selling pressure is weakening. Regular volume tells you there are many people in the room. Net volume tells you which side is speaking louder. How should you view the net volume metric? There are three basic ways to read net volume. First, look at whether it is positive or negative. Positive means buyers are more aggressive. Negative means sellers are more aggressive. Second, look at the size of the bars. If positive bars are getting larger, buying pressure is increasing. If negative bars are getting deeper, selling pressure is increasing. Third, compare it with price. If price is rising and net volume is also strengthening, the move is healthier. If price is rising but net volume is weakening, the rally may lack momentum. If price is falling and net volume remains deeply negative, selling pressure supports the downtrend. If price is falling but net volume no longer makes new lows or starts to recover, selling pressure may be fading. But remember, we are talking about probabilities, not certainties. A technical indicator is not a crystal ball. It is more like a translator. It translates hidden market pressure into something we can see. Real-world scenario 1. Distinguishing between true and false information. The first practical use is judging whether a breakout is real or weak. Many traders make the same mistake. Once price breaks above resistance, they immediately chase. But a breakout itself is not enough. What matters is the pressure behind the breakout. If price breaks above resistance and net volume turns strongly positive, with larger positive bars than before, buyers are actively pushing the market. That kind of breakout has better quality. But if price breaks above resistance, while net volume is weak or even negative, you should be careful. It may mean price has moved up, but buyers are not truly supporting the move. This type of breakout can easily become a breakout trap. So next time you see a breakout, don't only stare at the candle. Ask one more question. Who pushed this breakout? If net volume does not confirm it, don't get too excited too quickly. Once you get used to this way of thinking, many moves that used to look random will start to make more sense. Price is the result. Volume is the process. Net volume helps you see the details inside that process. This indicator series is not about memorizing formulas. It is about building market reading ability. Eventually, when you look at candles, you won't just see red and green bars. You'll start to see the pressure behind them. Real-world scenario 2. Signal deviation. The second use is divergence. Divergence means price and the indicator are not moving in agreement. For example, price keeps making higher highs, but net volume fails to make higher highs, or even becomes weaker each time. What does that mean? It means price is still moving up, but buyer aggression is fading. You cannot immediately say the market must reverse, but you should understand that the quality of the rally is weakening. On the other hand, if price keeps making lower lows, but negative net volume does not deepen, or the negative bars become smaller, it may suggest that selling pressure is weakening. The downtrend may be entering an exhaustion phase. But remember, Divergence is not an entry button. Many traders see divergence and immediately trade against the trend. That is risky. Divergence is more like a warning. The internal pressure of the trend is changing. For actual decisions, combine it with support and resistance, trend lines, candlestick structure, and the higher time frame direction. Common misconceptions about net volume. Now let's talk about common mistakes. Mistake number 1. If net volume is positive, you must buy. No. Positive net volume only means buyers were more aggressive during that period. It does not guarantee price will continue rising. If price is already at major resistance, positive net volume may simply reflect late buyers chasing the move. Mistake number 2. If net volume is negative, you must sell. Also, no. If price has already reached a major support area, negative net volume may represent panic selling. Sometimes the strongest selling pressure appears near a short-term emotional low. Mistake number 3. Focusing on one single bar. One net volume bar is not enough. You need to observe continuity. Is it suddenly expanding? Is it gradually strengthening? Is it just a one-time spike, or is it forming a clear pattern? Mistake number 4. Ignoring market structure. In a range-bound market, net volume may switch between positive and negative very often. In that environment, it is better used to understand pressure inside the range, not to chase every small signal. Net volume should not be used alone. It works best with 3 things. First, support and resistance. If price reaches support and negative net volume starts to shrink, selling pressure may be weakening. If price reaches resistance and positive net volume starts to shrink, buying pressure may be losing strength. Second, trend structure. In an uptrend, we prefer to see net volume stay relatively controlled during pullbacks and strengthen again when price moves higher. In a downtrend, we prefer to see net volume stay weak during rebounds and turn negative again when price continues lower. Third, price patterns. Breakouts, pullbacks, false breakouts, double tops, and double bottoms become more meaningful when net volume confirms the pressure behind them. In simple terms, price tells you where the market is. Structure tells you what phase the market is in. Net volume tells you which side is more aggressive inside that phase. Let's summarize today's lesson. Net volume is not just about how active the market is. It is about whether buyers or sellers are more aggressive. It can help us judge breakout quality, trend strength, divergence, and pressure changes near support and resistance. Remember 3 key points. First, positive does not mean blindly buy, and negative does not mean blindly sell. Second, focus on continuity, not just one bar. Third, always use it together with price structure. Once you start reading the market this way, you move from simply watching price rise and fall to understanding changes in pressure. That is where technical analysis becomes truly useful. It is not about predicting every candle. It is about noticing internal market changes earlier. In the next lesson, we'll continue with volume-based indicators. You'll see that volume is not just a number. It is a language that helps decode market emotion, capital behavior, and trend quality. Once you understand that language, charts stop looking like random red and green bars. They start to make sense. This content is for technical analysis education only and does not constitute investment advice. See you in the next lesson.